domestic institutional voice. Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us right now on the show. Mihir, so good having you. Thanks much for taking the time out. What's your sense, Mihir? We are at fresh highs. The only difference between now and the last period 2 months ago is that there has been some bit of participation other than the 25 names which have done well.
Yes.
Is there euphoria, is there optimism, or is there caution currently?
I would still say there is a bit of caution. I don't think the breadth is as wide as one would see in a case of euphoria, you know. So while everybody knows that there's a slowdown, the market seems to be going in the other direction. So people are still skeptical. So I think there might be some hope steam left in this rally.
So what are you working with? Are you working with this belief that usually, I mean, so many people that we spoke to said that the market typically knows more than what any of us know. If the market is trying to discount what will happen 6 months out at these levels, we might actually see or start seeing some recovery in the economic parameters as well. But earnings will definitely shore up. Is that what is the base case?
That is the hope, yes. You know, we have this good situation in which while the domestic news is not that great, as far as the physical numbers, credit growth, all those are concerned, we know there's a slowdown. But that seems to be the situation even globally. And the stance of the global central bankers, the ECB, the Fed, even the Chinese central bank, is very, very easy. So you have this situation in which any bad news on the global front is being countered by federal bank, the central bank actions of huge amount of liquidity. It's kind of a put. We are back to the central bank put again. And good that this is happening in a situation where we are facing a slowdown, because then we have some hope and liquidity rally which will sustain the markets by the time the numbers start picking up.
Let me just talk about the external factors also. US record high after record high, and we sort of following them in a way. But do you feel that this probably is overrun itself in a way, and the damage that happens from a setback from here could be that much more in nature and in impact?
It could be, especially in the large caps, given the way valuations are. But the thing is that we are not in normal times. Let's accept it. I mean, traditionalists like us who look at valuations and earning growth have been proven wrong for almost 2 years now. And that's because of the fact that we have a situation in which I think $15 trillion worth of global central bank bonds or government bonds are trading at negative yields. So this is not a new normal. The traditional models are going out for a toss, and we are seeing that there is a bubble in various asset classes, but how to call the top is very difficult. In the meantime, we have a situation where physical assets are not doing that great in India. So the funds flow to mutual funds and insurance continues, and we have this rally. Look, India cannot stay at 4% or 4.5% GDP growth for too long. I think it's only a question of time, and as long as we have this liquidity to sustain us, by the time that we catch up, it should be fine.
And it's interesting because so far, even in terms of fund allocation, no one's really talking about sitting on cash a little bit. In case there is a correction, then you get that favorable entry point. Everyone is pretty much deployed to the hilt. So in light of that, do you feel it's more prudent to sit on a little bit of cash at these record highs?
Yes, but the thing is that there is still enough value out there in the non-top 100 names, or even non-top 50 names, I would say, because while the Nifty is at record highs, we still see the mid caps and small caps really trading at not so great valuations. They're still 20 to 30% down. A lot of them are even 40% down. So in case there is any sign of a pickup, there is good amount of value out there. So with a patient 2 to 3 year kind of view, there is work to be done. There are stocks to be picked out there.
All right. So what exactly now strikes the eye? We've spoken about mid caps and small caps and the valuation gap starting to narrow down. But is it in which sort of pockets according to you? Because you don't really characterize mid caps as sectors, because
yes.
Like how banking has 40% on the index, banking doesn't have 40% in the mid cap space.
Yeah.
So how do you factor in those elements?
Look, I'll just ignore the obvious ones, which is consumption and banking, private sector banks, NBFCs, because I think there's unanimity that these are the pockets to be in, so I'll just ignore that. But it's also a fact that we cannot grow at 6 to 7% without private sector investments kicking in. and government spending. Whether the government blows the fisc or not is a different question, but the government and the private sector needs to start spending both on the infra front as well as manufacturing and real estate. So these are three pockets where there is still value out there. These are three pockets which have done really badly in the last few years. So whether we talk about the capex cycle, there are a lot of mid caps out there, because since we are discussing mid caps, so there are a lot of capital goods companies which are pretty much in the mid cap space. EPC companies used to be large caps, a lot of them have become mid caps now. And similarly in the real estate space, again, this is a segment which has not done well for quite some time. And if India has to come back to 6 to 7 to 8%, I don't think we can do it without these three pockets doing well.
If we don't come back at 6, 7, 8%, because a lot of people are saying, I think a couple of ex-RBI governors have been saying that 5 trillion by 2025 is a piper's dream. We will not do that. So let's assume we don't grow. Even if we grow at the current rates of growth, do you think real estate as a pocket does make a comeback? There are so many statistics that say that, just the contribution to economy versus the space in the market capitalization is so abysmally low that it has to move up.
Absolutely. So that's what I'm saying. And within real estate, given the new set of regulations around RERA, bankruptcy code, and builders have to now become more organized and more responsible to the customers, there is a structural change that has happened in the last 2 years. The trend towards unorganized to organized will continue. So there was a statistic in the paper where I think almost a third of the builders are out of business or have shut shop in India, in cities like Bombay, Chennai, Delhi, etc. And that trend will continue. The large listed players may continue to gain at the cost of the unlisted, unorganized players.
Would you be comfortable putting in money to work in real estate at the current time? Do you guys have real estate in your portfolio?
We have a small exposure, yes, not very much significant, but this is something that we are looking at with a 3-year kind of a view. And within the real estate space, not all of them are leveraged. So there is a perception that all the real estate companies are leveraged, but there are still a few out there which are run pretty well and which are not leveraged.
No, I think it's just that because people tend to paint the whole space with the same brush at times, and therefore even a good company might not get the valuation that it usually would otherwise.
That's what they do. That's what's happening in mid caps and small caps also.
I guess so.
Painted with the same brush. So Mihir, let me ask you, what's your view on infrastructure and on housing, and whether or not you see the residential demand picking up in a meaningful fashion? And then what happens to the feeder industries like cement, steel, metals? How all of that play out in a cycle?
So in cement and steel, we are seeing some uptick in the last year and a half. The affordable housing program seems to be doing reasonably well. We are seeing the statistics that the delivery of homes is reasonably well. So probably the reason why we have not seen cement demand collapse totally is because of the affordable housing push that the government has been giving, and there is traction out there, good monitoring, etc. Steel, similar situation on the structural part. But I think without additional swaps, whether fiscal or any kind of swaps, the real estate residential piece will still remain sluggish. So I'm still expecting, apart from the AIF that the government did announce to kind of help the real estate stress out, there are still more fiscal and tax incentives that need to be given. The stamp duties in India are too high, transaction costs are too high, there is no benefit of the second home if one wants to buy a second home in terms of taxation breaks, larger amount of tax breaks for interest components, etc. I think still a lot still needs to be done.
Okay. One final question, Mihir, and I'm borrowing it from the tweet that you've put out 8 hours ago, which is on India mobile internet speed, but I'm using that as a segue into telecom. If indeed telcos will not invest too much but still have the duopoly or the 3-player market that we are in, and rates move up, do you reckon that is a precursor for people to enter into the telco space now?
Yes. That if rates do creep up
in the next 2 to 3
months, let's see, because now today there has been a statement by TRAI, for example, saying that we will not interfere and put a floor on prices. So the situation is still fluid out there.
Okay.
But if rates do move up, then yes, we were very underweight on the segment after the announcement of the Supreme Court. When the things panicked, we probably added a bit. So we are closer to neutral now against almost a zero weight for almost 3-4 years. But if rates start moving up, this would be a segment to start increasing exposure to, yes.